Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing PayPal stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. PayPal is a service that allows people to pay for things online. You can send and receive money safely and securely. When you link your bank account, credit card, or debit card to your PayPal account, you can then use PayPal to make purchases online only at participating stores. Most countries in the world use PayPal. The way the company makes money is by charging a fee per transaction. If you deal with a regular bank, you sometimes have to pay monthly fees or keep a minimum. PayPal will never charge you a monthly fee, and there is no minimum balance required. It also does not charge for inactivity or limited use. The company owns Venmo, Braintree, Honey, and many more companies. They did try to acquire Pinterest, but that deal fell through. One of its co-founders is the famous investor Peter Thiel. It was originally called Confinity, and the company developed security software for handheld devices. They had no success with that business model, so they switched their focus to a digital wallet, which was the first version of PayPal. In 2000, it merged with X.com, an online financial services company founded in 1999 by Elon Musk. Elon Musk was replaced by Peter Thiel as CEO of X.com, and that company was renamed PayPal in 2001, and it went public in 2002. It then became a wholly owned subsidiary of eBay at a purchase price of $1.5 billion. In 2015, eBay spun off PayPal into an independent company once again. As of 12/31/21, it had 426 million active PayPal accounts, 392 million consumer accounts, and 34 million merchant accounts. In 2021, it processed 19.3 billion transactions with a value of $1.25 trillion. The company is headquartered in San Jose, California, and was founded in 1998. The ticker trades on the Nasdaq, Deutsche Börse, Mexican Bolsa, Xetra, Vienna, EuroTLX, Swiss, Sao Paulo, Lima, Buenos Aires, and London Stock Exchange. Let's get started with the model. This is a large cap company, 116 billion market cap. They're trading at $100 a share, and they have 1.2 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow peaked in 2021 at over 5.4 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's over 4 billion in 2021, a little lower than 2020. Revenue is the sales for the company, and that grows every year from 15 billion to 25 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are all the expenses directly related to generating the revenue. The cost to maintain its platform is part of cost of revenue. Revenue minus cost of revenue gives you your gross profit, and that grows each year, 14 billion in 2021. Below that is their operating expenses. Their big operating expense is technology and development. Also, marketing is a big operating expense for them. Gross profit minus operating expenses gives you your operating income, and that also grows every year up to over 4.3 billion. They pay 232 million of interest on their debt, which is the most they paid in a one-year period. Then below that is other income and expenses. These are all the gains or losses not part of the company's core operations. Below that is their pre-tax income, then their taxes, and the bottom line of the income statement is their net income. And the reason it was so high in 2020 was this large gain in other income and expenses. I would just focus on operating income when I look at the income statement, not net income. This is the company's income statement directly from their 10K. And this shows us 2019, 2020, and 2021. Their revenue in 2021 was 25 billion. A little more than half their revenue is in the US. They have 2.3 billion in the UK and 9 billion in other countries. That's a nice thing about investing in a tech company. It's easy for them to scale all over the world. And their revenue has been growing in each region. It is flat in the UK in 2020 and 2021. Most of their revenue are the fees per transaction, but they also earn $2 billion from value-added services. Value-added services is revenue earned through partnerships, interest and fees from credit products, referral fees, subscription fees, and other things as well. Their biggest expense is transaction expenses of $10 billion. They need to pay expenses to third parties and banks every time a transaction occurs. And they do guarantee the money, so sometimes they do take losses, $1 billion in 2021. That's a lot lower than 2020 of $1.7 billion. They have to pay a staff to support their customers, $2 billion, marketing, $2.4 billion, technology and development, $3 billion, general and administrative, $2.1 billion. Their operating expenses are $21 billion, and their operating income is $4.3 billion. The big gain in 2020 of $1.8 billion was mainly the gain on strategic investments of $1.9 billion. This is their gain in investments in other companies, but this is a non-cash item, so it gets reversed out on a statement of cash flows. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. And that peaked in 2021 at $6.3 billion. Then you have CapEx, investments in property, plant, and equipment. Here's a list of their property and equipment on their balance sheet. $3.3 billion of computer equipment, $3.3 billion of software and development costs. They also have land and buildings, leasehold improvements, furniture and fixtures, etc. Operating cash flow minus CapEx gives you your free cash flow. Free cash flow is the cash that's remaining for you, the investor. A way to reward shareholders is to give a dividend. They do not. But another way is to buy back stock. And they buy back lots of stock every year. $3.5 billion, $1.4 billion, $1.6 billion, and $3.4 billion. Every time a company buys back common stock, it decreases the shares outstanding. It makes your shares more valuable. In 2021, they paid down a little debt. But before that, they've been adding a lot of debt each year. $4 billion in 2020. $3 billion in 2019, and about $1 billion in 2018. This is their operating cash flow section directly from their financial reporting. And the way you calculate operating cash flow, you start with your net income, then you add or subtract the non-cash items on the income statement. Remember that $1.9 billion gain in 2020? We subtract that out here since it's a non-cash item. We add back $1 billion for credit losses. They didn't actually pay $1 billion. This is a provision. They put the money up for future losses. We add back $1.3 billion of depreciation and $1.4 billion of stock-based compensation. Then we have to adjust for changes in working capital. So they did pay $1.2 billion in credit losses, which is similar to last year. The amount they post is different than the amount they actually pay. Sometimes companies post more because they expect higher losses. Sometimes they post less because they expect less losses. But the company never knows who's going to default on their payments. They reported an accounting gain of $4.2 billion but generated $6.3 billion of cash flow. I like to track revenue, that's the blue line, and operating cash flow, that's the orange line. And their revenue goes up a ton every single year it grows. Operating cash flow is a little more volatile, but it is positive every single year, so that's good. The forecast is for their revenue to continue growing at a pretty fast pace. Also, their operating cash flow is forecasted to grow at a fairly slow pace. This is their investing and financing sections from their statement of cash flows. The top of the investing section is purchase of property and equipment. That was $900 million. And they supplied $1.6 billion of loans to their customers. They do have a lot of cash sitting in their bank account at any given time. So they invest that cash in short-term investments. Those investments could be really short, like overnight. And a similar amount of those investments have matured. They spent $2.8 billion on acquisitions. Last year was $3.6 billion. So in their investing section, they had a cash outflow of $5.5 billion. Last year was a cash outflow of $16 billion. That's mainly from the short-term investments. In their financing section, they bought back $3.4 billion of stock. Last year was $1.6 billion. They paid $1 billion of taxes. This is related to the shares they provide their employees. They received $3.6 billion of transactions. This money is not due to them, it's due to their customers. So they just have to transfer it to their customers. And sometimes transfers take 1, 2, or 3 days. So in their financing section, they had a cash outflow of $800 million. Last year was a cash inflow of $12 billion. Last year, they borrowed a lot more debt than 2021. This is the equity section on their 12/31 balance sheet. They have $22 billion of equity. they bought back 12 billion of common stock. When a company buys back common stock, they put it on the balance sheet as treasury stock. And this is a contra equity account, so it brings down your equity balance. They sold 17 billion of common stock and they profited 16.5 billion from running their business. Let's look at the capital structure. 22 billion of equity, 9 billion of debt. They're 71% equity, 29% debt. And they could pay off all the debt with the cash on the balance sheet and still have $500 million of cash left over. This blue line is their equity balance since 2015, and you can see that goes up pretty much every year. They weren't using much debt until 2017, and they've been adding a little more debt each year. Debt is a cheap way to finance growth. It's a lot cheaper than issuing equity. And this blue line is their cash balance, so they always have more cash than their debt. I gave them the highest whack on Finbox, 8.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 174 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $152 billion. We divide that by 1.2 billion shares. And we get a calculated stock price of 131. They're trading at 100, so they're trading at a 24% discount. It's a buy according to the model. I grew it by that amount for the next 4 years. That's how I got their future revenue estimates. In the past 4 years, on average, they converted 24% of their revenue into free cash flow. So I multiplied their future revenue estimates by 24%. That's how I got their future free cash flows. The website Simply Wall Street values the company at $291. They're saying it's 66% undervalued. 36 analysts priced this stock, and the average price target is 184, the lowest 125, the highest 245. The stock was growing steadily until March 2020. Then it really blew up past $300 a share. And the stock has plummeted since then. And this bottom chart shows their RSI, Relative Strength Index. The higher the RSI, the more overbought the stock is, or overvalued. The lower the RSI, the more oversold or undervalued. The way to calculate the RSI for any given period, take the average gains of the stock price the past 14 days, divided by the average loss of the stock price the past 14 days. Of course, this is not a foolproof system, it's just one indicator. So if you really like the RSI, the stock seems like a good value. In the past 5 years, the S&P 500 is up 82%. Even with the big drop, this stock is up 158%. That just shows you buying and holding and not trying to time the market generally works better in the long run. They have a beta of 1.29, so the stock moves a little more than the market. It's gone down 55% in the past 52 weeks, while the S&P is up 14%. The 52-week low is 95, the high is 310, and the stock is on a major decline, trading below its 50-day and 200-day moving average. And there's a lot of activity on this stock recently. Nearly 27 million shares are traded each day. All the shares outstanding are on float. 79% are held by institutions, and 2% of the shares are shorted. A good sign is seeing a company adding employees each year. They're currently at 31,000. If you invested $10,000 into this company when they started trading, you'd be at $27,000 today. That's a 16% annual return. But if you did invest in 2015, you're probably not that happy because a year ago, your investment was close to $70,000. A good sign is when insiders are only buying and not selling. In the past year, there's been a lot of insider buying. 78% of the company is held by institutions, 22% by the general public. If you own this stock, you're part of that 22%. 8 basis points by insiders and 4 basis points by the state or government. The biggest shareholder is Vanguard at 8%. They have 94 million shares valued at $9.4 billion. Then BlackRock, State Street, Comprehensive Financial Management, and Fidelity. Let's look at their financial ratios. They have a PE of 28, that's stock price over earnings per share. Price to sales of 4.6, that's stock price over sales per share. And a price to book of 5.3, that's stock price over book value per share. Let's look at their non-current assets. 6.8 billion of investments. These are their investments in other companies. 1.9 billion of property and equipment. 11 billion of goodwill. Goodwill is the premium you pay when you acquire another company. 1.3 billion of intangibles. Of the 1.3 billion, 800 million is from customer lists. So when they acquire another payment processor, They usually don't care about their technology. They just want their customers. 90 million is marketing related, 287 million of technology, and 148 million of other, and 1.7 billion of other assets. Let's look at their non-current liabilities. 3 billion of deferred tax liabilities. This will increase their tax bill in the future, and 8 billion of debt. They have a good ROIC of 16%. They can cover the interest payments with their operating income 19 times. They have a high ROE of 19%. The market median is 7%. And a good current ratio of 1.2. That's current assets over current liabilities. Let's look at their current assets. 5 billion of cash, 4 billion of short-term investments, 800 million of accounts receivables. This is how much money other people owe PayPal. 4.8 billion of loans they provided. So they're owed this money since it's a receivable. If it's a loan in the liability section, that means that's debt they took out and they owe that money. 36 billion of funds receivables. These are transactions by their customers and this is money owed to them. You'll see a fairly similar amount in current liabilities. It's just the timing of transactions. And 1.3 billion of prepaid expenses. This is when they prepay for a product or service they're going to receive in the future. Let's look at their current liabilities. 39 billion of funds payable. These are funds they owe their clients. And these are just the transactions between the parties. 3.8 billion of accrued expenses. These are expenses the company has incurred but hasn't paid it yet. And they owe 236 million to the IRS. In 2021, they generated over 5 billion of free cash flow. They have nearly 10 billion of working capital. So the company is well funded. They have nearly $15 billion of funding. The best way to look at ratios to compare them to companies in the same industry. There are 63 companies in the same industry as PayPal, and PayPal ranks 4th in market cap. The only companies bigger are Visa, MasterCard, and Amex. That's impressive how fast they moved up this list. And they're only behind these 3 massive companies that have been around for many, many decades. Their price multiples are worse than average, so this would imply that the company is overvalued. But they're growing at a great rate, 18%, which is much better than average. And they have a good ROA, that's net income over assets, and a good ROE, that's net income over equity. So to summarize, I have them trading at a 24% discount. And I've probably been using PayPal for about 15 years now. And that's my go-to, either PayPal or Venmo. So I'm probably a customer for life. I'm not sure if it's going to get back up to $300, but I think there's a chance it could hit $200 this year or next. But there's a lot of volatility and craziness going in the market, so no one can really know this for sure. I rank their free cash flows and revenue 8 out of 10 and their ratios 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.